Compound interest does not build wealth. Getting your money to work for you does not build wealth in the real world. And real estate investors, one of the first things they need to do is actually stop looking at property.
It is with great pleasure that I get to introduce you to our first speaker for today. He is the founder of Get Rich Education and host of the popular Get Rich Education podcast. He also actively invests in apartment buildings, single-family homes, and agricultural real estate, including coffee farms in Panama. He is a member of the Forbes Real Estate Council, and his work regularly appears in Forbes, Business Insider, and Rich Dad Advisors. Today, he's taking us back to the basics to discuss why real estate is such an attractive and solid investment option for those looking to find their own financial freedom. If you've listened to the Get Rich Education podcast, then you've heard him speak. But today, we are so thrilled that he's kicking off our second annual Spartan Summit. Ladies and gentlemen, here's Keith Weinhold.
Hi, my name is Keith Weinhold. I am the founder of Get Rich Education. My presentation is called simply Why Real Estate, because if you don't know why you're doing something, then you really won't care about how. You're going to hear some things that you've never heard before today. For example, compound interest does not build wealth. Getting your money to work for you does not build wealth in the real world. And real estate investors, one of the first things they need to do is actually stop looking at property. So what is this financial heresy that I'm talking about? Well, I think it's going to be pretty clear to you in less than an hour's time here. One thing this is not is that this is not tax or legal advice. So before investing your money, you do want to consult a professional. Hey, I'm really honored to be here at the Spartan Summit. I want to give a big thanks to Clayton Mobley, Lindsay Davis, Jesse King for helping put this together, and the wonderful Maureen McCann, who's the person I've dealt with the most over the years there at Spartan Invest. It all starts with you thinking differently. You really need to open yourselves up, and I think you start to have the realization that any outsized thinker or doer over time did think outside the box to have that outsized impact, whether that's Thomas Edison or Jeff Bezos or Sarah Blakely or Warren Buffett. They all dared to think differently. And if you're not getting the results that you want in life, maybe a great question to ask yourself is, am I thinking differently enough? When you come of age in the world, whether you finish high school or college or whatever it is, you probably never really have this vision for yourself where you're intentional and you say, yeah, I can't wait to go out there and live a small life. But then you know what? That's exactly what everyone does. Everyone goes out and lives a small life. So with thinking differently, Mark Twain's got some great quotes about thinking differently. Mark Twain said, as soon as you find yourself on the side of the majority, it is time to pause and reflect. Mark Twain also said, one of his lesser known quotes is, go out on a limb, that's where the fruit is. Yeah, I absolutely love that one. So being a conformer does not build wealth or does not have a substantial positive impact on other people. And I wouldn't suggest that you think differently or do something differently if I weren't doing that myself. I don't know that I've had the outsized impact of some of those visionaries and inventors that I mentioned earlier. I probably haven't had as many years on this earth yet as them either. But one thing I did that was different is years ago, I moved from Pennsylvania, where I was born, raised, and lived much of my life, to Anchorage, Alaska. Well, that was deemed by Pennsylvanians and a good part of my peer group as a strange and unusual thing to do, but I knew that a place like Anchorage fit my interests for skiing and mountaineering because I had vacationed there. That was the place for me. The first ever home that I bought of any kind, I was only a rent-paying tenant up until the day I bought a fourplex building where I lived in one unit and rented out the other three. That was pretty strange. I didn't start with a single-family home. I quit my job, my good-paying day job with benefits for residual income from real estate. Another strange thing to do. I launched the Get Rich Education podcast in the year 2014. Kind of weird, talking to myself in a little room all by myself. A lot of people didn't understand what I was doing then. So those are just some examples of some different things I've done. Your different things are probably going to be different, but you really don't want to be a conformer. If you think about it, high school was the place where you were rewarded for fitting in, But when you become an adult, really you get rewarded when you stand out and you don't be that conformer. So I talk about real estate investing, wealth mindset, and real estate economics every week on the Get Rich Education podcast. And I really talk about what I've learned through real estate in my 18 years of being a real estate investor. It's been 18 years since I bought that first fourplex building. And over those 18 years, I've heard everything from cash is king to cash is trash. And really, one thing I've learned is that wealthy people's money, it either starts out in real estate or it ends up in real estate. It's one or the other. And actually, most real estate investors don't even understand how they're paid. Even they don't get it. So I break it down. But Get Rich Education is not get rich quick. If you want to build wealth and quit your job and completely change your whole lifestyle in 6 months, I don't think I can help you. But if you want to do that in 5 to 10 years, I can definitely help you. So it's about building durable residual income streams over time, the most generationally proven way with real estate. And some of my influencers are Robert Kiyosaki, the Rich Dad Poor Dad author, and Russell Gray of the Real Estate Guys. So as you see my presentation, at times maybe you'll see threads of their influence in there. And I've had a lot of those same names on the podcast with me. Some people that have come on to the show and run alongside me for an episode, or Robert Kiyosaki was on with me 3 times now. Jim Rogers, Jim Rickards, T. Harv Eker, Grant Cardone was on with me last year. Ted Benna, interestingly, B-E-N-N-A, he was the actual guy that invented the 401k plan. He came on the show with me and he went on to say that 401ks really aren't even serving people the way that they were intended to. Some other things I do are I write for the Forbes Real Estate Council. I've been with them a little over 2 years, I guess almost 3 years now, writing real estate articles with Forbes. And, you know, maybe this sounds impressive or something, but I truly mean that if I can do this stuff, you can do this stuff. Anyone can. I'm probably somewhat more like you than what you think. So what I do through my podcast and my media is what I really try to do is just tell you the things that I wish that I would have known before I started, because I didn't understand real estate before I started. So the podcast is one of the most successful things I've ever done. It has more than 3 million listener downloads. There's been a new show every Monday since 2014. And I reach people also through the GetRichEducation.com website and our Get Rich Education phone app and videos and articles and newsletters and a book. And most of our listeners are in the United States. Some of our other popular listener nations, the top 5 there include Canada, the UK, Australia, and South Africa. And it was a real honor among all these places where I've written articles and appeared actually to write for the Rich Dad Advisors, because I kind of grew up on the Rich Dad series of books, so it was great to be a contributor there. But when we talk about my presentation called Why Real Estate, we're really taking it from philosophy all the way through to the numbers here. And 18 years ago, I would have loved to know why real estate made ordinary people wealthy. You know, an interesting thing, I'll just tell you, when I bought that first fourplex building, I didn't even know what terms like cash flow and equity meant. I did not even know the meaning of those terms. And here I had owned a substantial building, a $295,000 fourplex, which is a lot for me when I was working a day job, and I bought it. And I think as a layperson, before I bought that building and got down this road, I kind of thought, now how could real estate possibly make people wealthy? Because real estate only appreciates at about the rate of inflation over time. That's about all it does. And I found that that part's true. And then real estate, it has the elements working on it from the outside, and it has tenants like working on it and wearing it down and degrading it from the inside. So how could real estate possibly be a good investment? I didn't understand that. I tell you, it's really important for you to learn from someone that's actually doing it, that's inside and doing this thing. I'm about as active as a real estate investor could possibly be. I own single family rental homes up to larger apartment buildings, even some agricultural real estate. So it's important to learn from someone that's doing it. And this presentation is really what my 18 years have shown me. And when we talk about how you have to think differently and be opened up, you know, interestingly, we're in what people call the information age. We have been for decades, this information age, but I like to say we're really in the affirmation age because most people would rather be affirmed and comforted in what they already believe rather than get informed with information because it kind of shakes you up a little bit, just like you're going to be shaken up today. So I would say don't only seek affirmation, which is what most people do, seek information as well and then make up your own opinion. What is wealth? You know, we kind of begin with the end in mind. Let's ask ourselves what is. I think that there are a lot of different definitions for that. I mean, money's got to be one of the first things that come to mind. And we are talking about financial betterment here. But, you know, it seems like people that want material things more than experiences, it seems like a lot of those people that want material things get knocked and get criticized. I don't know, like I would rather have experiences than stuff, but really the abundance mentality is why not have both experiences and stuff if they're both easily within reach, because they really are. But I think really the best definition of wealth, it's one that I've never heard criticized once in my life, is freedom. Having the ability for you to do whatever you want to do whenever you want to do it. Real wealth is having that time freedom and not having to have a job, being job optional. You can continue to go if you want to. Wealth really is freedom. So let's talk about money and freedom and what freedom really isn't. I've actually got a really nice proposal for you. Just imagine this. Imagine you're 20 years old. I'm talking to the 20-year-old version of you. I'm going to tell you that I want you to mow my lawn for me regularly, and I am going to pay you $114 an hour to mow my lawn. Pretty amazing, right? Like, doesn't that sound incredible? Yeah, that sounds like a good deal. You'd probably be pretty excited about that. Maybe even now you'd be excited about that, not just the 20-year-old version. But could you ever really get wealthy off that? Probably not, because in fact, you would have to work every single hour in a year, all 8,760 hours in a year, just to make your first $1 million. And that ain't happening. This scenario is completely implausible. No one would really pay that much to mow a lawn, most likely. And you couldn't work every hour in a year. You couldn't eat, you couldn't sleep, nothing like that. So it's really numbers like this that I think kind of slap someone in the face if they think they can just hustle and grind their way to wealth. I really don't think that's the best way. In fact, what I would share with you is that this is the exact opposite of being wealthy. This is the opposite of growing rich in your sleep, because you have to continue to trade your time for dollars in order to make this work. You need to continue to sell your time for money in order to make this work. And then really what happens when you come of age and get older and you're probably not mowing lawns for money anymore, you end up in a place that looks kind of like this, okay? And this is the workplace. What happens in the workplace? I like to say the workplace is where you pretend to work and your employer pretends to pay you. This worker here, they're doing something else that the lawnmower didn't do. Okay, we're gonna say that you mowing the lawn, that classified a poor person. You had to work for money. But the middle class person here, they're also working for money, but they do have a better and higher use of their investing dollar. They're also getting some of their money to work for them in something like a 401k or a 403b or a thrift savings plan or something like that. So the middle class person here, they get some of their dollars working for them. That's significant. But look, here's the real point. Getting your money to work for you doesn't build wealth, and all these middle class people here, they think there couldn't possibly be anything better than me getting my money out there working for me, so I'll just leave it there. It can't get any better than having my money work for me. Well, that's not true, and I find it to be a real conundrum and paradox that people will spend tons of time learning about how work works. They spend zero time learning about how money works, but yet money is the only reason that they even go to work, which is really unusual to me. See, getting your money to work for you does not build wealth. Now, that doesn't sound too bad on the surface, but if you think about a 10% return over the long term from the S&P 500, which is about what you could expect, most people don't even consider the 5 deleterious drags on that 10% of inflation and emotion and taxes and fees and volatility. All 5 of those simultaneous drags. Now, I think some of these are easier to explain and understand than others. For example, if you have a 10% rate of return and 3% inflation, which is a long-term historic norm, you're already down to a 7% inflation-adjusted rate of return. We haven't even subtracted out those other four things yet. And I like to look at things in really long timelines. So let's take a look at some long timelines with some returns you can expect. And therefore, I also like to look at inflation in a long timeline. We'll call it 3% inflation. You've got to beat inflation substantially in order to have any real return. And things like stocks, mutual funds, ETFs just don't do it. So let's look at long timelines of, let's say, over 100 years here. I talked to you about the drag of inflation. Let's talk about the drag of volatility. This is little understood. Stocks are quite volatile. They go up and down. They're choppy, where real estate is a substantially smoother ride. So let's look at two different lines here on this graph. Okay, over the last 120 years, since about the year 1900, the stock market has averaged roughly that 10% return, 6% from capital appreciation and 4% from dividends. So therefore, the green line, this shows capital appreciation. You're probably pretty used to seeing this, the compound return. This looks thrilling. Your mutual fund advisor loves to show you this line. This line goes like exponential. Like, who wouldn't want some of that, right? Some even believe Einstein was purported to say that compound interest is the eighth wonder of the world. So what's wrong with it? Where does it break down? Okay, well, I'm going to show you a second line, and both of these lines show a 6% return from the year 1900, more than 120 years of return. So the green line is what you think you got, but what did you really get with this 6% quote-unquote compounded return? You don't get this, you get this. That's what you really got. This is the deleterious effect of volatility on stock returns. You're like, well, whoa, wait, well, why did that happen? How did that happen? The difference here is that whole effect of, let's say you have a $100 stock and it loses 50%, now it's down to $50, but it gains back 50% the next year, now it's only up to 75. So you've gone from $100 down to $75, even though you lost 50% in year one, say, and you gained 50% in year two. So it's really a mathematical problem. Another way to say it is that time spent making up previous losses is not the same as growing your money. It's not the same as compounding your money. In fact, the tip of the blue line, the end of it there, today's dollars, that's only 38% of what you get at the tip of the green line and what you expect to get. So a lot of investing has to do with expectations. If you expect the green line and you only get the blue line, that's when you end up like this, you know, sort of these stereotypical stock kind of photos when people can't pay the bills. And the interesting thing is we've been in a 401k based world for 35 to 40 years now where that's sort of the norm. People continue to end up like this, but yet they still get into 401ks and think getting their money to work for them is a way to build wealth. Well, we're here and we're talking about why it isn't. And that is the problem. And compound interest does not bail people out of their income and savings problem either. 4 out of 5 people have less than 1 year's worth of income saved for retirement. This is why we have a retirement crisis today. You can't count on compound interest alone. I would like you to imagine another pretty dreamy scenario for yourself. Okay, and this is a pretty important exercise. This is some better news for you. I want you to think about how much money you think you're going to make, both earned and through investment returns, your entire life. We'll say it's inside this vault right here, okay? And the reason that this is some better news is, you know what, if you're in this room virtually, the chances are that you're going to have a greater net worth and greater residual income than other people will because you've shown up here. You've shown that you're interested in this. And a lot of people, they don't think about inflation and they underestimate their life's earnings. So let's say that your entire life's net worth, accumulated assets would be the way to say it. Let's say your total accumulated assets are coming up to $8.5 million. How's that sound? $8.5 million. That sounds pretty good, doesn't it? Wouldn't that be amazing? Now, just imagine this. I'm going to give you all $8.5 million at one time. You're going to receive this all at once. How would that feel? I think, wouldn't that be amazing? How fast are you going to quit your job? Hopefully you at least give the 2 weeks notice. Where are you going to go on vacation? Are you going to have time to care for your loved ones now? Or be a volunteer at Habitat for Humanity? Or finally have time to be a deacon at your church? Or do whatever's important to you, because you are job optional now with this $8.5 million delivered all at once. But wait, here's the thing. I didn't tell you when the $8.5 million is being delivered to you all at once. It's all going to be delivered to you on the last day of your life. That's when you're going to get it. What do you do now? I guess you're not going to do your around the world trip anymore, right? You're just saying your goodbyes to people. It's the last day of your life. All right, what if you got 80% of this amount then at age 80? Would that be a little better? Or 70% at age 70? Would that be a little better? So my point is timing matters. I don't know, what can you really do if you get 70% of it at age 70? Maybe when you're 73, that's the last year you can really paddleboard very well because you've had 6 knee surgeries by then or something. So timing really matters. So you really want to be invested in something that gives you an income stream, that provides liquidity to you over time. You really, ideally, most want this sort of lifestyle smoothing effect where they get this income metered out to them. So liquidity really, really matters. And what helps achieve this smoothing? It is those income streams. In fact, I would go as far as to say that the standard advice that you hear out there from people, invest for your future, period, I'd actually say that's bad advice or incomplete advice. Why would you only invest for your future? When you can invest now for a stream of income now and not hemorrhage or sacrifice the future at all, which is really something that you can do with real estate. Build an income stream now. It typically appreciates faster than stocks, and you didn't sacrifice the future at all. There's more bad advice out there. I think sometimes you'll hear a person say, for example, oh, pay yourself first. That means put your money in a traditional retirement plan or something like that. Pay yourself first. Wait a second, how in the world is it paying myself first if money is deducted from my paycheck when I'm, say, age 35 and I don't get that back until, say, I'm age 75? Look, with the 401k, the most popular plan in the United States, you cannot take penalty-free distributions until between age 59 and a half and 70 and a half. That's just when they begin. And you also must begin paying taxes on it at that time. So would you really find it a good trade if you trade away 1 hour of your 35-year-old self and in return you get 1 hour of your 75-year-old self? Does that sound like a good trade? A lot of people that invest in these traditional retirement plans, that's really the trade that you're making. And I used to be involved in traditional retirement plans. I used to think they were the best thing until I looked at it. A lot of people talk about the benefits of delayed gratification, and I think delayed gratification, there's something implied in that being a desirable thing, that there's a positive outcome and that there's some big reward for delayed gratification, but it's definitely not guaranteed. We're not guaranteed tomorrow. So I think 401k plans, they're known as tax deferral plans, but I think you could just as easily call them life deferral plans because that's principally what they do, in my opinion. Let's go back to the lawnmower. The lawnmower, again, I'm classifying that as the poor. However, the middle class are doing a little something different. Remember, not only were they working for money, they got some of their money to work for them, oftentimes in a retirement plan. I guess they're symbolized by these, what do they look like here? Construction engineers or something like that. They're middle class. But you'll notice that black rectangle on the right there. The wealthy are doing something that the poor and the middle class aren't doing. The middle class, they get their money to work for them. What do the wealthy do? What is this guy doing right here? What does he have figured out? He knows the best and highest use of his investing dollar is not getting his money to work for him. It's getting other people's money to work for him. And in real estate, you can actually get other people's money to work for you 3 ways at the same time, and you can do it ethically. I think it's important to be ethical. You never get called a slumlord. Like, for example, my mission is to provide housing that's clean, safe, affordable, and functional. You can use other people's money 3 ways at the same time. We'll call this OPM, other people's money. You might have seen that abbreviation before. You can do it 3 ways simultaneously with real estate, And you know, the great thing is you don't need any degree. You don't need any certification at all in order to ethically use other people's money 3 ways at the same time. The first way is with the bank's money. Like for example, the way I bought that first fourplex is with 3.5% of my own money as a down payment, and I borrowed the other 96.5. So you use the bank's money for the loan and leverage. You use the tenant's money for that all-important income stream and for paying down your loan for you. And then the third way you use other people's money simultaneously in real estate is that you use the government's money for very generous tax incentives, like you can defer your capital gains tax endlessly. You can get a mortgage interest deduction. There's something called depreciation, which shelters a portion of your rent income from ever getting taxed. Don't get your money to work for you, or at least don't make that the focus. The focus should be on ethically getting other people's money to work for you. And you know, I think really a concept like this harkens back to the late business philosopher Jim Rohn, right? Jim Rohn said, formal education will make you a living, but self-education will make you a fortune. So you're really getting a condensed self-education right here. So let's just look at one of these 3. Let's talk about that tenant income stream. That's the important one. That's the one where you build residual income if you do want that freedom, if you do want to build enough of that residual income so that you can be job optional and do what you want to do. Think about it conceptually. Think about how amazing it is that the tenant pays you what they pay you. The tenant pays completely 1/3 of their income most of the time in rent to you, 1/3 of the time. So that is like you getting paid and that tenant going to work for you 10 days every month. We'll call it the first 10 days of every month, just to work for you and to pay you. Do you have any idea how amazing that is? Think about that. What other company gets 1/3 of people's incomes and can do it at scale? Apple doesn't get 1/3 of people's incomes. Think of all the stuff that people buy on Amazon, all those consumer products, but people still don't spend 1/3 of their income on Amazon. So this is amazing. Like, who else gets this? Really, nobody but you in real estate. So, you know, we're getting you to think differently here. This is just, again, one of the 3 ways that you can ethically employ other people's money. The others were the bank's money and the government's money. We're talking about the tenant's money here. So now some people can get pretty excited when they listen to me and they often want to go out and maybe learn a little more, but sometimes they buy a property a little too soon. In fact, I see it happen so often that the advice I actually need to give you oftentimes as an interested real estate investor is stop looking at properties. Yeah, stop looking at properties. Now, how could I say that? Don't you need a property? I mean, here's a rental property. We'll call this a blue duplex. Yes, you do need a rental property, but a lot of people think of the property as the most important thing in real estate investing. And really, the property is only the 4th most important thing in real estate investing. So how do some people buy real estate? Well, they're not very strategic. Say this is a blue, again, we'll call it a duplex that you see, and say you make a round trip to work, you're a commuter, so you see this blue duplex twice most days, and you think it always looked kind of pretty, it has some good paint on it, it's got some good landscaping going on, and one day you see a for sale sign on it, and you think, well, I've heard that real estate is a good investment, and because I drive by it twice a day, yeah, you reason that you could manage this yourself, and you kind of let emotions get behind it because it's always looked pretty. Well, first of all, if you're managing it yourself, it's pretty difficult to make that income residual, and you probably just aren't very strategic. You let emotions get behind it, and I think you're positioned to fail. More often than not, you fail because you weren't very strategic, because their property popped up near the bottom of the slide. The property is only the 4th most important thing. And you know, when people rush into property and then they have a bad experience because they didn't vet the tenants or they didn't understand the market they were in, that's when they end up saying things like, well, I guess real estate doesn't work and I just sold that building for a loss and it was a big hassle and the tenants always paid rent. No, I don't think that that investor was very strategic. So let's take a step back. In real estate investing, the most important thing is you. We're putting you at the top of this. What do you want real estate to do for you? Are you looking for long-term appreciation? Or are you looking for tax advantages? Is that what's most important? Or are you looking for lifestyle investing, where it's a sort of property where you might want to live or vacation there 2 or 4 weeks a year or something like that? Or are you looking for cash flow, the residual income stream? And that really is, I would say, the top answer for people. It's probably still my top answer. I look for properties that provide cash flow. What do you want real estate to do for you? Once you're aligned there, the second most important of 4 things is the market. What market is going to provide what you said that you wanted? And we can think of markets in a few different ways. We can think of markets as use type, like there's a mobile home park market, there's a condominium market, there's an apartment market, there's a single family rental home market. But oftentimes we think about market as geography. What's the type of geography that would produce the best sort of yield on a cash basis or on a cap rate basis? Cap rate is just simply basically the income divided by the price of the property without getting too technical. What are the markets that are going to work? Like, for example, Alabama is one of those markets where you do get a high ratio of rent income to purchase price, which is a really important formula for cash flow. Other places are like North and Central Florida, Tennessee, a lot of the markets in the Midwest, Ohio, Indiana. Some of those, what markets are going to produce that? Oftentimes it's not in the market that you live in, and it's easier than ever to invest across state or even national lines now than it's ever been before. So now that you're aligned on the market and you know that there are some good fundamental drivers, now you have this anchor, you have this feeling that you're getting closer to being able to look for a property. Importantly, you want to be in a market where there's enough economic diversification. You don't so much want to be investing in a property in a town of 8,000 that's well outside of a medical area where half the jobs are dependent upon the zinc mine that's out there in that town or whatever it is, or else if something happens to that zinc mine or the price of zinc goes down, half your tenants might not be able to pay the rent anymore. So you want diverse economic sectors. Think about that market. Now, once you're aligned with yourself in the market, the next most important thing before you get into looking at property is the team. The team of professionals that you surround yourself with. So what's the team really mean? The team are all those people that help make this investment possible for you. In the beginning, that could be team members like your title agent and your property inspector. Always get an independent third-party inspection before you buy a property, even new construction. But really the most important team member that you'll have, and the glue that makes this entire thing stick together, since real estate investing in residential property, it is typically a long-term investment. That's what we're talking about here. Long-term buy and hold real estate investing is what this entire presentation is about, is your property manager. They're the glue that makes it stick together. They're the ones that need to communicate with you if there are problems. They're the ones that screen tenants, and they're the ones that take those tenant maintenance requests. So now that you're aligned with yourself, the market, and the team, now and only now do you start looking at property. And it's a pretty great feeling when you know you're aligned on those first 3, you, the market, and the team, and you can start looking at property. And as you look back at these 4, I think there's 2 that you could make the case where 2 of these 4 are interchangeable. You have any idea which 2 of these you could probably swap, and I might be all right with that? I think you can swap market and team. If you want to see the team's the second most important and the market's third, yeah, I might agree with that. But the reason I put the market ahead of the team is you could change a team member pretty easily if you had to, compared to market. If you bought in the wrong geographic market, that's a lot more difficult to change. That's why I have market ahead of team. So get aligned that way. Now you're strategic. Now you're setting yourself up for success. And as you're looking at these 4 criteria, if you're wondering if any 2 of these could be interchangeable and swap positions, I would contend that you might be able to swap the market and the team. You might be able to say that the team is more important than the market. The reason I put the market ahead of the team is if you have a bad team member, it's substantially easier to replace a team member if something happened rather than replace the market, like the geography that you've already bought inside. So those 2 might be interchangeable. Again, my name's Keith Weinhold. The name of my presentation is Why Real Estate. I am with Get Rich Education. You're watching the Spartan Summit. And when we talk about why for real estate, you know, so many people go out and they do the wrong thing. They buy the property first and then only after they bought the property, maybe a few weeks or a few months later, they try to find a property manager and just hope that there's a good one in that market where they've already bought, and then they try to figure out the market that they already bought in. That doesn't work. So don't make that mistake. So next, let's talk about some numbers. I mean, this all comes down to an ROI. Like, what kind of return on investment could you expect from a long-term buy and hold rental, we'll say single family home in this case. And you know what's interesting? Even among people that don't like numbers, if you don't like numbers, I'll tell you something, those numbers get a whole lot more interesting when we put a little dollar sign next to those numbers, okay? And then it gets even more interesting when you realize that we're not just talking about somebody else's dollars, we're talking about your dollars here. So that's what gets more interesting. And you know, the great thing about real estate math is in doing this for 18 years, not once in my real estate math have I ever needed to use trigonometry or calculus or exponents for any reason. It's all addition, subtraction, multiplication, and division. So real estate math is pretty easy. We're going to look at this example of if you make a $20,000 down payment on a $100,000 property, a rental property that you don't plan to live in. That's typically what you need to do, is put 20% down. And you can actually find $100,000 properties that make sense for investors that are newly renovated with a tenant in them and already under management in the United States Midwest and South. And that is called turnkey real estate investing. When the property is already in that condition, the numbers just tend to work better in that part of the country. And if you're thinking about how, oh, well, you would want to buy a more substantial property, what's this small 100K property about? Well, we're all talking about ratios here. So if you're eyeing a $5 million apartment building, you just multiply all these numbers by 50 that we're going to look at here. And this is really exciting. This is where your return comes from. Most real estate investors don't even understand this. So you've carefully purchased this 100K rental single family home where the monthly rent income is projected to exceed all these expenses. So the first of 5 ways, up to 5 ways, a real estate investor is typically paid is with appreciation. It certainly doesn't always happen. We're just talking general long-term averages here. And so after year 1, your property appreciates from 100K up to 105K. All right, well, 5% appreciation, that's not very interesting in itself. And I'm using 5% because the NAR, the National Association of Realtors, says the long-term appreciation rate is 6%, but I'm running this entire example kind of on the conservative side. So we'll just call it a 5% appreciation rate. This is a very important thing for you to keep in mind and pay attention to. You have benefited from financial leverage because look, on this property with your 20K down payment, you borrowed 80K from the bank. So with a 5% return, your $5,000 gain, that's divided by the amount you have invested, your skin in the game, which is just 20K. Well, a $5,000 gain divided by your 20K of skin in the game, that's a return of 25%, not 5%. You got a 5% gain on the asset, but you got a 25% ROI. You got a 25% return on the amount that you've invested. You just benefited from a financial leverage. And you really start to understand why I say compound interest is lame. Leverage is what builds real wealth. And maybe you're waiting, well, wait, still, how did that happen? How did we go from 5% to 25%? That happened because you got a 5% return on both your 20% down payment, and you also got a 5% return on the 80K that you borrowed from the bank. See, the bank doesn't get that return. That entire return goes to you. And maybe you're wondering, well, wait, what about the interest payment that I'd have to pay on the loan? Well, remember, no, in a cash flowing rental, your tenant pays your entire interest payment monthly and a principal payment on top of that and a little bit on top of that called cash flow. All this debt has been reliably outsourced to the tenant as long as you buy right, as long as you're strategic, like what we talked about with the blue duplex example. The second of up to 5 ways you're often paid is with cash flow. Cash flow is your monthly rent income minus all of your monthly expenses. So let's just use an example and we'll say you have a $1,000 rent income minus $900 in all of your expenses, only leaves you with $100 of cash flow. So the $900 of monthly expenses that you need to deduct from your $1,000 rent amount, those are things like the mortgage, principal and interest, a factor for vacancy, then insurance, maintenance, taxes, utilities, and management. You deduct all those things. Let's say you only end up with $100. Again, that's really not very thrilling, $100. So that $100, that is $1,200 annualized. That $1,200, that still gets divided by the same 20K of skin you have in the game. Well, that's another 6% return. And look, you're up to a total ROI of 31% now. We've only talked about 2 of the up to 5 ways that you're typically paid. The third way is with loan pay down. Your principal is getting paid down by your tenant. And now if you own your own home, you might be thinking, oh, well, I already have this benefit, because when you make a payment to the bank every month, you see that a portion goes to principal and a portion goes to interest. But no, there's a difference here, because in your own home, you had to work to make the principal pay down. In a rental property, it was your tenant's labor, those first 10 days of the month, right, that go into paying down that principal. So you actually have another rate of return here. Since we're just running things very conservatively, we'll say you have to pay a 5% mortgage interest rate. If you pull down an amortization table, you see $90 to $100 per month in principal pay down that your tenant would need to make for you on an $80K loan. We'll just be real conservative and say that's just $1,000 annually that your tenant pays down for your principal. That's another 5% return, because that $1,000 annually is divided by your same 20K of skin in the game. The fourth of up to 5 ways that you're paid with real estate are with tax benefits. And these can get myriad and a little more complicated, so we're really not going to delve down into all those things. But we're talking about things like the ability for you to endlessly defer your capital gains tax. I've legally never paid capital gains tax in my life on my real estate through a vehicle called a 1031 exchange. You also have something called tax depreciation, which means a portion of your rent income is sheltered from taxes. You have the mortgage interest deduction. We're just going to roll in this entire benefit and call it 5%. That's really getting general. The fifth of up to 5 ways you're commonly paid with real estate is with one of what I really think is the least understood phenomenon in the real estate investing world, and that is you're profiting from inflation. And you might be wondering, well, how do I profit from inflation? Doesn't inflation just debase and diminish the purchasing power of my dollar? Yeah, it does. So if you can understand this, you understand something that billionaire with the B, billionaire real estate investors don't understand this. And most experienced real estate investors in general don't understand these up to 5 simultaneous profit centers. And this is nothing new. This is just buy and hold real estate investing. It's just something that you've never seen before. This is why real estate makes ordinary people wealthy. And you know, you're going to have seasons in your investor life where you might imagine that, hey, this is the right time for you to go on offense with your investing, or this is time for you to move your money around and get more defensive with investing. But when you have up to 5 profit centers, you're investing in both offense and defense at the same time. With the first 2 profit centers here, appreciation and cash flow, yeah, I'd say they're more offensively minded. And then with the second 3, with the loan pay down, the tax benefit, and the inflation profiting, those are kind of things that are going on in the background. I would call that defensive investing. You're doing both at the same time. You don't have to choose. And for you, now you know how to keep score. This right here, this is keeping score in real estate investing. And when you know how to keep score, now you know what to buy, what and when to sell, when to do a cash out refinance of your property, when to do a 1031 tax deferred exchange perhaps, and try one of those. Now you know how to keep score, you know what to do. And yes, we could get more precise than this general 44% total ROI number. I mean, your return is going to be higher or lower than that, most likely. It won't be exactly that. But we could get more exacting in this number if we had like 18 spreadsheets and all these tax tables and everything, and maybe we could get a more precise number. Rather than 44, it would be 42.12 or something like that. But it's just not worth it. It makes your head spin. This is to give you some idea, a good idea, of where your returns come from. And I think one takeaway here is you have the ability to give your dollar multiple jobs at the same time. A lot of people aren't used to that. A lot of people are just used to getting a capital gain and getting paid one way, like with stocks, or some stocks have a dividend as well. That could be a second way of getting paid. A lot of stocks don't even have a dividend, and the average dividend yield in the S&P 500 is only 2% anyway. So my point is, give your dollar multiple jobs. Take your dollar and wear it out, crumple it up and make it into a paper airplane or a butterfly. Wear out old George. Wear out old George Washington. Give your dollar multiple jobs. One of the problems with putting faith in compound interest in the long term, to talk more about that again, is remember the 5 simultaneous drags on stock investments are inflation, emotion, taxes, fees, and volatility. We talked about some of that. With the emotional part, most people, like with stocks, when they've only got one way to make a gain, that means that they need to buy low and sell high. That is harder to do than people think. Most people think that they can do it, just like most people think that they're a good driver, right? 8 out of 10 people say that they're a better than average driver, but mathematically only 5 could be. I would imagine that investors say largely the same thing, because here's what happens with emotions when you're only trying to get a capital gain. You only have one possibly way you can get paid. Let's say you're an interested stock investor and you're on the sidelines and you see a stock begin to go up. And as it goes up, you see this momentum and you get somewhat more interested in buying the stock, and soon you get some friends around you that are buying this stock or that are in the market, and you kind of get this context that maybe it's something you should be participating in. And the market keeps going up, and you're now getting bathed in this media bath of all these articles that the stock market continues to go up, and you as an investor, you're experiencing FOMO, fear of missing out, and you just rationalize buying. You buy now when the stock market has run up high, because you can at least rationalize that you're not missing out anymore. So now you've just bought high. So what typically happens after you've bought high, since you're trying to get a capital gain? Shortly after you've bought, because the market has just about crested, the market begins to go down. If it goes down 5 or 10%, you're not too worried about it. Maybe you call it a correction, and that's okay. Then the market goes down 20%. It continues to slide. You're getting concerned. You've heard about some other people selling. Now you're getting bathed in this bath of negative media articles. As the market goes down 30%, you keep looking at it, you keep checking it, and you know what? You're getting really fed up with it. And what you're doing is you're thinking about selling, and now your emotion, again, you rationalize that, well, at least I'll have certainty in knowing that I cut my losses. I am so tired of waking up every day and seeing that I've lost money. So now you've sold low. Well, you just bought high and sold low. This is exactly why emotions play in to stock investments, and even why most mutual fund managers can't beat, rather, the S&P 500. So that's why you can keep emotions out of real estate investing. It's not so volatile. So give your dollar multiple jobs. That's the point. And really, we talk about thinking differently. We've got this entire think different paradigm here. We talked about how inflation is your friend because it debases your debt amount. At the same time, it increases your asset value. But thirdly, what inflation does, it increases your cash flow disproportionately to the amount of the inflation. Let's say, for example, this is one of your rental doors. You actually want inflation because, look, let's just go back to the example we used previously. If you have $1,000 in rent income and $100 of cash flow, what happens if you get 3% inflation and you can transfer that onto the next tenant that comes in? Well, your $1,000 rent income went up to $1,030. But here's the thing, your cash flow, your $100 of cash flow went up to $130. That seems a $30 increase as well. That is a 30% gain on your cash flow. Extrapolate that out across your entire portfolio. That's the money you feel in your pocket every month. So inflation is your friend. I have another module where I talk about how real estate investors win the inflation triple crown. And you're probably going to own more than just one $100,000 property with only $100 cash flow. You have all these multipliers, but inflation really enhances this effect. And again, you want to have a loan, because when you have a loan, what you're doing is you're leveraging your cash flow increase. And the great thing about having a loan is it's kind of that opposite of saving. It's the opposite of putting $1 million under the mattress. Because if you put $1 million under the mattress for 30 years, at a 3% inflation, do you know how much purchasing power that has? $412K. Okay, so your $1 million is whittled down to $412K in purchasing power after 30 years. Well, you're smart enough to know that you would not put $1 million under a mattress for 30 years because inflation would erode its purchasing power. In fact, if you do that, after 30 years at a 3% inflation rate, your money only has $412K of purchasing power, so you would not save money. But because it's so little understood, I want to explain to you that if you borrow money, the opposite effect would happen to you. You don't need to pay back as much in real dollars. So let's take a look at what inflation does to most people. That's the long term of inflation over time. That's what it does plotted out over a chart, that diminished purchasing power of the dollar. It takes more dollars to buy that same thing. So with inflation, today, a dollar only has about 3% as much value as it did 100 years ago. But oppositely, inflation benefits you when you're the borrower, and again, your tenant pays the interest. So look, here's what happens with inflation profiting. We know that inflation debases savers' money, but look, inflation enriches the debtor. All I did was flip that over. There's the long-term run on inflation, 100 or more years of inflation. We just invert the chart when you borrow. That's the effect that you get because inflation impoverishes savers and enriches debtors. Inflation also transfers wealth from lenders to borrowers. And you might be wondering, why would inflation transfer wealth from older people to younger people? That is because older people have more assets and younger people have more debt. When you realize this, like I do, even when I'm older, I want to have my debt so that way I can have both things, right? I mean, why not have your cake and eat it too if you can have both, if you can do that? So, you know, the next time you show up at one of your favorite restaurants and you're standing in line at Chick-fil-A and just say your favorite sandwich went from $6 to $7, well, maybe you did not want to really pay an extra dollar for your sandwich there and get that surprise, but that might be a sign of a good thing. It just might be a sign of inflation. And when you have this long-term fixed interest rate debt tied to cash flowing assets in markets where there are diverse economies with a good manager, inflation really makes you wealthier. It makes most people poorer here when they buy their sandwich at Chick-fil-A. In fact, I did one Get Rich Education podcast episode last year called The Debt Decamillionaire. You might have heard the term decamillionaire, someone with a net worth of $10 million or more. Well, if you have more than $10 million in debt, or you're just exactly $10 million in debt, you probably have an asset value that's greater than that. But you know what happens to your $10 million in debt at a 3% inflation rate? You have a $300K inflation profiting tailwind. Or if you have $1 million in debt, you have a $30K inflation profiting tailwind. And a lot of people don't even think about that. So instead of doing what most people do, you might very well want to get rid of dollars in a sense and get debt. A dollar's value, that is just like an ice cube melting in your hand. So that's something that you want to think about long term as an investor. And really, this is another reason that I'm known for saying financially free beats debt free. Why would I spend an extra dollar to pay down mortgage principal at a 3 or a 4 or a 5% interest rate when instead I can invest another dollar in another property and get that 44% rate of return, like with what we were talking about there in the example? So there are so many different types of residential real estate for doing buy and hold investing, but I think a lot of people think of single family homes versus apartment buildings. Those are really the main two categories. And apartment buildings certainly have an economies of scale advantage over single-family homes, but single-family homes and investing in those rental properties have a lot of advantages over apartments that a lot of people just don't often think about. Single-family homes also have an advantage over apartment buildings of tenant quality. These are all just generalizations. In general, you're going to get better tenant quality from people that live in a single-family home than that live in an apartment building. You also tend to get better appreciation over time. with single-family homes, they tend to be in better neighborhoods than apartment buildings. Again, these are just broad generalizations here. They tend to be in a better school district, and because they're in better neighborhoods and in better school districts, you get better retention. You have a tenant that typically stays in that single-family home longer than would stay in an apartment building. And that single-family home, it really feels like theirs. It really feels like their own when there aren't any shared communal areas. And as real estate investors know, when you get turnover, that's when your expenses come up. You have a vacancy and then you have make-ready expenses to get the new tenant in there. But tenants are retained longer in these single-family homes. You don't have any of these common areas in single-family homes. Now, like I said before, I invest in both apartment buildings and single-family homes, but I get bills every month for my apartment buildings that someone had to go in and clean the hallways and the stairs and the laundry room and places like that. There aren't any common areas to service in single-family homes, and those tenants typically pay all the utilities in a single-family home. They even take care of the lawn, where generally the larger the apartment building is, the more utility expenses are borne on you, the investor. The next is something I like to call divisibility. Let's say you buy one 10-unit apartment building and it's in an area and it's performing not so great. It's just not performing as well as you would have wanted to. Well, now you have a decision to make. You either need to hold that building or sell the entire thing, all 10 units. But if you bought 10 single-family homes and you had one or two underperformers, you could sell off the one or two poor performers. That's divisibility and the advantage you have. And that really plays into market risk. This is a bigger risk. If you buy one apartment building, that can only be in one geographic market tied to one set of economic conditions and tenants with jobs and the ability to pay the rent. But if you bought 10 single-family homes, you might buy 4 in Dallas and 3 in Philadelphia and 3 in Birmingham. You've really spread your risk around. You can do that more easily with single-family homes. Noise and pestilence. Oh gosh, I've had an apartment building with a bed bug problem, and it's so difficult to exterminate them and isolate them because they scurry to another unit. If you had one of those bad problems in a single-family home, it can be taken care of quite a bit more easily. Another one is financing. The availability of financing terms are generally better for single-family homes than they are for apartment buildings. The interest rates are lower, and you can get these long-term 30-year loans with no balloons on single-family homes. The vacancy rate, that kind of plays into the retention. Since tenants stay longer, you have a higher occupancy rate, hence a lower vacancy rate in your single-family homes. And single-family homes are also really good for beginners because it just doesn't take as much money to get a rental single-family home as it does an apartment building. And supply and demand, there's a chronically low supply, especially these past few years, of affordable single-family homes for you to buy. Overall, there's a housing shortage of about 2.5 million units in the United States. So just the overall supply-demand fundamentals for real estate in general are really good right now. And then really the last one is the exit strategy. When you go to sell down the road, if you sell an apartment, only an investor is going to buy an apartment building. But when you go to sell your single-family home, maybe an investor would buy it, or maybe an owner-occupant family would buy it, one that wants to own it and live there themselves. You've got more exit strategies with single-family homes than you do with apartment buildings. So those are 15 advantages of single-family homes over apartment buildings. But really in all this, in this whole thing, with what we've learned, the ROI that you're really looking for, that return on investment that you really want, is freedom. And you've got freedom when the residual income from your properties exceed all of your living expenses. And you have the ability to do it with a proven vehicle like real estate when you're still young enough to enjoy it. You know, a lot of people out there say things like, you know, I want to be frugal, I want to be tight with my money. You know, that's okay. Sometimes you got to do things that you got to do for a short period of time. But I think what people really want to say is, I want to live well. They don't actually want to say, I want to be frugal or remove the joy of life from things. They want to live well, but they just don't know about a vehicle for living well. And now I think you do with buy and hold residential real estate investing. The name of my presentation was Why Real Estate here at the Spartan Summit. It's been a real pleasure to deliver this to you. Thanks so much for stopping by.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for Forbes and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.